Welcome back. This is Module 1, and now we're looking at Topic 2. Here we're going to look at the types of shares to invest in. So this is a quick and short module, and let's get started. So what are the different investment options you have as an investor? Okay, so in all honesty, there are many, more than the scope of this particular topic, but we're going to look at just three as an introduction, just to get you started. And you'll find that a lot of other options tend to be variations of what we're going to show you. So first of all, we look at bonds. We touched on that in the first topic of Module 1. And corporate bonds that we looked at was a way for companies to raise money from investors. And corporate bonds basically represents debt. So if a company issues corporate bonds to investors, they are borrowing money from investors, which means that they have debt. They are taking on debt. So a corporate bond is a debt instrument. And then you have ordinary shares. So whenever we talk about shares, they are ordinary shares. It's just financial market jargon. You can call them shares, or you can call them ordinary shares, or you can call them, equity. So ordinary shares basically represents equity in the business. So the main difference between a bond and ordinary shares is that a bond represents debt, whereas ordinary shares or shares represent equity. So when you buy shares as an investor, you're actually buying a stake in the company. You're buying a piece of the equity, you're buying a piece of the company. So with bonds, you are just borrowing money to the company. So there's no transfer of ownership or part of ownership in that particular company when it comes to bonds. And then you get a mixture of the two. You can call it a hybrid. We call them preference shares. And preference shares, it's a blend of bonds and a blend of ordinary shares. So if we look at preference shares, as the name suggests, they are shares. So it represents an equity stake in the company. But then they behave similar to bonds. And this is how. So if you buy shares in the company, you're buying an equity stake in the company, and you're basically buying a share in the company's earnings or their profits. So if a company doesn't make profits, they're not obliged to give you a share of the profits. And also if a company has made profits, but they choose to reinvest those profits to grow the business or to expand, they don't have to pay you as a shareholder anything. They don't have to pay you a dividend. Whereas with preference shares, when you buy preference shares, you do actually get a fixed dividend. So it's a fixed income stream that you get from preference shares. And that's what makes preference shares similar to bonds, because if you lend a company money by buying a corporate bond and giving them cash in exchange, a company has to pay you interest payments, which are also known as coupons. So the similarity there is that for bonds, a bondholder earns coupons. Preference shares, the preference shareholder earns a fixed dividend. Whereas with ordinary shares, there's no guarantee. You could earn a dividend, you may not. It depends whether the company chooses to pay a dividend or not. And that's also what makes shares, ordinary shares, more risky than preference shares, because with preference shares, at least you have that, that assurance that you'll be getting some sort of income stream, whereas with ordinary shares, it's not guaranteed. And you've probably heard this before, that with a higher risk that you take on, there's higher rewards. So when you buy ordinary shares, you stand to gain more than someone who just buys preference shares, because preference shares, it's just a fixed income stream, whereas with ordinary shares, if a company does spectacularly well and they decide to pay a huge dividend, you could make a lot of money from that dividend that you would earn. So let's have a look at the risk-reward profile or the risk-return profile. So whenever we talk about reward, it's return, and return basically what you get in return for what you've invested. So if we look at from a low to high risk, where you've got low risk, you tend to get low returns, and where you've got high risk, you tend to get high returns. So if we had to compare bonds, preference shares, and ordinary shares on this risk-return scale, what do we find? Right at the bottom are bonds, and then you have preference shares, which are less risky, and you have ordinary shares, as I've explained, which are the most risky. So, you know, because bonds represent debt in a company, a bondholder is basically a creditor of the companies, and should anything go wrong, creditors stand first in line to get money from the company. Whereas ordinary shareholders are at the opposite end of the spectrum. If something goes wrong, they stand to lose all that they've invested in the company. So that's just touching on risk and return. And that actually brings us to the end of this topic. And then the next topic, topic 3, we're looking at the rewards of being a shareholder. So do join us for that one.